Welcome back, everyone. If you've been following this channel for a while, you know that we don't do fear-mongering here, and we don't chase hype. What we do is take complex market situations, slow them down, and walk through them together so you actually understand what's happening and why it matters to your financial life. Today's topic is one I've been building toward for several months. We're talking about silver, and specifically we're going to talk about why a growing number of serious institutional analysts, the kind of people managing billion-dollar portfolios, are quietly watching this market with a level of focus that most everyday investors haven't noticed yet. Let me be upfront from the start. Nobody knows exactly what silver will do. Markets are unpredictable. What I'm going to do today is walk you through the structural situation in the silver market as it stands right now in 2026, explain the mechanics of how a rapid repricing event can happen in a commodity, and let you draw your own conclusions. This is about understanding, not about telling you to buy or sell anything. I'll leave those decisions to you. Agreed? Good. Let's break this down. To really appreciate what's happening, you need some background on silver itself, because silver is genuinely unusual among all the metals in the world. Most commodities are either primarily industrial or primarily financial. Oil is industrial. Gold is mostly financial. It sits in vaults and on people's wrists. Silver sits in a strange middle position that makes it unlike almost anything else you can hold in your hand. Roughly half of all silver demand globally comes from industrial applications, electronics, solar panels, medical equipment, semiconductors, water purification. The other half comes from investment demand, coins, bars, exchange-traded funds, jewelry. That dual nature is exactly what makes silver such a fascinating and sometimes volatile asset. When industrial demand surges at the same time that financial demand surges, the market gets squeezed from both directions simultaneously. And right now, in 2026, both of those forces are activating at the same time. Let's start with the industrial side, because that's where the story really begins, and it's the part most people are dramatically underestimating. Think about what's happened to global energy infrastructure over the last 5 years. Solar panel installations have exploded, not grown, exploded. Every solar panel requires silver. Specifically, silver paste is used in solar cells to conduct electricity efficiently, and there is currently no substitute that performs at the same level without making the panel significantly less effective. As countries around the world have accelerated their commitments to renewable energy, partly because of climate policy, partly because solar has genuinely become one of the cheapest forms of electricity generation available, the demand for silver from the solar sector has grown faster than almost any forecast from even 5 years ago predicted. Here's a number worth sitting with. In 2015, the solar industry consumed roughly 50 million ounces of silver per year. By 2025, that figure had grown to somewhere in the range of 200 million ounces annually, and projections for the next several years suggest continued growth, not a slowdown. Think about it this way. We're in the early to middle chapters of a global energy transition that took decades to get started and will take decades more to complete. The solar installations we're going to add globally over the next 10 years will dwarf what we've already built. That means silver demand from just this one sector alone is expected to keep climbing steadily. Now add to that the electronics industry. Every smartphone contains silver, every laptop, every circuit board, every radar system. Silver is the best electrical conductor of any naturally occurring element on Earth. It outperforms copper in critical applications where you cannot afford resistance or heat buildup. As global middle-class populations in Asia, Africa, and Latin America continue to grow and gain access to consumer electronics, total global demand for those products keeps rising. The underlying demand engine here isn't a trend. It's a demographic reality that plays out over decades, not quarters. So you've got solar pulling silver demand up, you've got electronics pulling it up, you've got the medical sector, where silver's antimicrobial properties make it valuable in wound care and surgical instruments, pulling it up further. All of this is happening at the same time. Now here's where the story gets genuinely interesting, because on the other side of that demand equation, you have the supply situation, and the supply situation for silver is not keeping pace. Silver is mined in two primary ways, either as the main product from dedicated silver mines or as a byproduct of mining other metals, copper, gold, zinc, lead. The majority of silver that comes out of the ground globally is actually a byproduct. That's critically important because it means silver supply is not directly controlled by the silver price the way you'd intuitively expect. If the copper price collapses because global growth slows, copper mining operations pull back. And when they pull back, less silver comes out of the ground as a byproduct, even if the silver price is rising. Silver supply is in a meaningful way hostage to production decisions being made in other metal markets entirely. On top of that, the primary silver mines that do exist are facing challenges common across the entire mining industry. The richest and most accessible ore deposits have largely already been found and exploited. New deposits tend to be deeper, lower grade, or in more difficult geographies. That means higher costs, longer timelines from discovery to production, and greater regulatory complexity. Building a new major silver mine from scratch today takes 10 to 15 years from initial exploration to meaningful production. Even if demand is clearly growing right now, the supply response simply cannot happen quickly. This is not like adding a second shift at a factory. Mining has a geological and logistical inertia unlike most other industries. The Silver Institute has reported silver market deficits, meaning demand exceeding new mine supply for several consecutive years. While some of that gap has historically been filled by recycling and existing above-ground stockpiles, those sources are finite. Recycling responds to price, meaning you get more recycled silver when prices are higher, but there's a ceiling. And above-ground investment inventories, the silver bars sitting in warehouses, backing exchange-traded products, have been declining in some markets as industrial buyers draw down available stock. Now here's where the institutional analysis piece comes in, and this is what I find most compelling from a market mechanics standpoint. Let's break this down clearly. Commodity markets have something called open interest, a measure of how many contracts are outstanding between buyers and sellers of a commodity for future delivery. In the silver futures market, there are consistently far more paper contracts outstanding than there is physical silver available to back them. This is somewhat normal in commodity markets. Most futures contracts are settled financially rather than with physical delivery. Buyers and sellers use them to hedge price risk. But the ratio of paper silver to physical silver in this market is unusually high, and it has been for a long time. Here's why that matters. When genuine physical buyers start showing up, not traders using paper contracts to speculate, but actual industrial companies who need real silver for real solar panels, and they can't find enough physical silver at current prices, you can get what market participants call a squeeze. The paper price, set by futures trading, starts to disconnect from the physical price, what you actually have to pay to get real metal delivered today. And when that disconnect becomes large enough, it can create a feedback loop that moves prices very quickly. Think about it this way. Imagine a theater where the fire exit can handle a normal flow of people, but there are 3 times as many people inside as the exit can accommodate at once. Most of the time, that's fine. People aren't all rushing out simultaneously, but when something triggers a rush to the exits, the capacity problem becomes suddenly and violently obvious. The silver market has structural characteristics that rhyme with that analogy. Most of the time, the paper and physical markets stay close enough together that the gap doesn't matter. But conditions are forming where that gap could matter enormously. The mechanics of a rapid repricing event in a commodity like silver are different from a stock market rally. In stocks, sentiment drives a lot of the action. In commodity markets, physical reality can force repricing regardless of what sentiment says. If there genuinely isn't enough silver to meet demand at current prices, price has to rise until either demand is destroyed, buyers decide it's too expensive and find alternatives, or new supply is incentivized. The higher price makes previously uneconomic mines worth opening. Those two mechanisms are the market's only tools for rebalancing a physically tight market. The critical question is always, how fast does that rebalancing happen? The answer depends on how large the imbalance is and how inflexible the demand is. In silver's case, some demand is highly inelastic. A solar panel manufacturer who has committed to a production run simply has to have silver. They cannot easily substitute something else mid-process. If silver becomes scarce at current prices, those buyers will bid the price up because they have no choice. That kind of forced buying, concentrated over a short period, is what produces a rapid, large price move. The $300 figure you saw in the title, let me address that directly and honestly. It represents a level that some institutional analysts have projected as a possible outcome in a genuine supply stress scenario. It's not a prediction, It's a scenario analysis. There's a meaningful difference. A scenario analysis says, if these specific conditions are met and this chain of events unfolds, here is what price would need to be to rebalance the market. Silver trading in early 2026 makes $300 look like a very large move, and it would be. That would represent a multi-100% increase from current levels. Moves of that magnitude don't happen in normal conditions. They happen when physical scarcity meets forced institutional buying, meets a crowded short position in the futures market, all at the same time. In the futures market, there have historically been large short positions in silver, held by commercial participants hedging underlying physical exposure. This isn't a conspiracy, it's a structural feature of how these markets work. But it does create an interesting dynamic. If prices start moving upward sharply due to physical demand, those short positions can become extremely expensive to maintain. At some point, holders may need to buy back their contracts to limit losses. That buying adds fuel to an already moving market. It's called a short squeeze, and silver has historically been one of the markets where this dynamic can be dramatic. If you were around in 2011, you remember what a rapid repricing looks like in this metal. Silver went from roughly $17 per ounce in late 2008 to nearly $50 per ounce by April 2011. Nearly a 200% move in under 3 years. It didn't go in a straight line, and it ultimately reversed, because supply did eventually respond and industrial demand softened during that period. But that kind of move shows you the range of motion this metal is capable of. The difference between 2011 and 2026 is that the industrial demand base is now much larger and more structurally embedded. The solar industry in 2011 was a fraction of its current scale. The structural floor for silver demand is now genuinely higher than it was during that last major run. Now, I want to be genuinely balanced here because honest analysis has to acknowledge the risks and counterarguments. There are real reasons why a major silver repricing might not happen, or might be much smaller than aggressive scenarios suggest. Recycling supply increases significantly when prices rise. Higher prices bring more scrap silver back from industrial waste streams and old electronics. Industrial users are not static. If silver becomes very expensive, engineers work harder to develop substitutes or use silver more efficiently. Economic slowdowns reduce industrial demand. A significant global recession could soften solar and electronics production meaningfully. And monetary conditions matter. If policy changes reduce the appeal of hard assets as a hedge, investment demand could weaken even as industrial demand grows. These are real counterforces. Anyone who tells you a silver repricing is certain or inevitable is overstating what can honestly be known. If you're finding this useful, this kind of structural market analysis, take a second and hit subscribe for the John Smith 02 channel. We cover these stories regularly, always with the same approach. No hype, just honest analysis. Leave a comment below telling me what other markets you'd like us to dig into. Now let's keep going. The world's largest silver-producing countries include Mexico, China, Peru, Chile, Russia, and Australia. Notice anything? Several of those countries have experienced significant geopolitical complexity in recent years. Mexico has faced regulatory and security challenges around mining. Peru has seen repeated social conflicts near mining sites. Russia has faced broad economic isolation in Western markets. China, both a major producer and consumer, manages its supply in ways that aren't always transparent. This geographic concentration adds a layer of fragility that doesn't show up cleanly in base supply-demand numbers. If a major operation in any of these regions is disrupted by political instability, labor action, or environmental regulation, the supply impact can be immediate and difficult to replace. Let me give you a simple mental framework to carry forward. When evaluating any commodity market, ask 4 questions. First, is structural demand growing, and how inelastic is it? For silver in 2026, yes, demand is growing, and a significant portion of it, the solar and electronics piece, is relatively inelastic in the short term. Second, can supply respond quickly to price signals? For silver, no. New mine supply takes many years to develop, and much of it is byproduct mining outside silver's direct control. Third, how much above-ground inventory exists as a buffer? For silver, stockpiles are meaningful but finite and declining in some categories. Fourth, is there a positioning structure in the paper market that could amplify price moves? For silver, historically yes. large short positions, and a high ratio of paper to physical contracts create conditions where price moves can be self-reinforcing. When all four of those indicators point in the same direction simultaneously, that's when institutional analysts start paying close attention to the possibility of a stress-driven repricing event. Right now, in 2026, all four are, to varying degrees, aligned. There's also a broader macroeconomic backdrop worth acknowledging. In 2026, global monetary conditions remain complex. Central banks have navigated an extraordinarily unusual period since 2020, extraordinary stimulus followed by inflation, followed by aggressive rate adjustments. The aftermath has left a landscape where uncertainty about currencies, inflation, and real returns on financial assets is elevated compared to historical norms. In that environment, hard assets, physical things with intrinsic utility, tend to attract more attention from investors looking for something that holds value independent of any particular government's monetary decisions. Silver benefits from that broader environment in a way that adds to the industrial demand story. When both the monetary environment and the physical supply-demand environment point toward the same asset at the same time, the potential for a sustained price re-rating is higher than when only one of those forces is active. So let's bring all of this together. Silver straddles the line between industrial commodity and monetary metal in a way that makes it respond to a uniquely wide range of market forces. On the industrial side, solar energy expansion, electronics demand, and the broader electrification of the economy are driving demand growth that is real, measurable, and expected to continue. On the supply side, structural constraints, long lead times, byproduct-dominated production, geographic concentration in complex regions mean supply cannot respond quickly to rising demand. The result has been consecutive years of market deficit. In the paper markets, structural features can amplify price moves dramatically when stress occurs. The broader macroeconomic environment creates additional incentive for institutional and retail investors to consider hard assets, and the combination of all these factors is what a growing number of serious analysts are pointing to when they describe the conditions for a rapid, stress-driven repricing in silver. The $300 scenario is not a certainty. Let me say that clearly one more time. It's a possible outcome in a specific set of conditions. There are real forces that could prevent or delay it. What serious analysis points to is not a guaranteed outcome, but a set of structural conditions that are more unusual and more aligned than they have been in a long time. Whether or not that alignment produces a major price event, understanding those conditions helps you see this market more clearly than the majority of people who have never stopped to think about it. That's what I want you to walk away with today. Not a prediction, not a call to action, but a clear mental model of how this market works, why physical supply and demand matter more in commodities than almost anywhere else in finance, and why the specific combination of forces currently present in the silver market deserves more attention than it's getting from most mainstream financial media. The story is still unfolding. The data will keep coming in, and I'll keep breaking it down here on this channel the way we always do, honestly, carefully, and with as much clarity as I can bring. Thanks for spending this time with me today. If this helped you see a market or economic dynamic more clearly than you did before, that's exactly why we do this. Share this video with someone in your life who's been curious about silver or commodities but hasn't known where to start. Subscribe if you haven't already. We've got more structural market analysis coming. Leave your questions below. I genuinely read them, and they shape what we cover next. I'm John Smith. Take care of yourselves out there, and I'll see you in the next one.